Hey everyone, welcome back to Corporate Decoder, the place where we unravel the financial secrets that move the markets. And today we are diving deep into Lincoln Educational Services with their latest quarterly report. And let me tell you, things are looking up, but also a bit shaky around the edges. So what's the big story here? Lincoln, a company focused on career education, is showing some serious growth in its core operations, but they're also making some big bets on expansion that are showing up in their numbers. Sure, let's get straight into the financials. Looking at their balance sheet as of June 30, 2025, Lincoln has total assets of about $447 million, a slight increase from over $436 million at the end of last year. On the flip side, their total liabilities are around $266 million, meaning they have more assets than debts. That's generally a good sign. Now let's talk about where the money is and where it's going. Their cash position has really changed. At the end of 2024, they had nearly $59 million, but by June 30, 2025, that number dropped to just over $16 million. That's a big dip, and it signals that they've been putting their cash to work, likely to fund their growth plans. And speaking of putting money to work, their property and equipment has seen a significant jump. It's up to almost $149 million from about $103 million at the end of last year. This increase is likely tied to their expansion plans, like opening new campuses. Now for the profit and loss statement, the heart of any financial report. For the 3 months ending June 30, 2025, Lincoln pulled in over $116 million in revenue, a solid increase from about $103 million in the same period last year. That's a jump of 13.2%. However, their selling, general and administrative expenses also went up from about $58 million to over $67 million. While revenue is up, their costs are also climbing, which is something to watch. This climbing cost meant their operating income, which is what's left after paying for the core business operations, went from a loss of about $1.1 million last year to a profit of nearly $2.9 million this year. That's a massive swing, and it shows they are improving their core business efficiency. At the bottom line, they reported a net income of over $1.5 million for the quarter, a big turnaround from a net loss of about $0.7 million in the same period last year. Looking at the first 6 months of the year, revenue is up by 13.4% to $234 million. And their operating income for the 6-month period is even better, swinging from a loss of $1.6 million last year to a profit of nearly $6.3 million this year. Now let's dig into the cash flow to see how they are funding all this. Their investing activities showed that capital expenditures, which is money spent on things like buildings and equipment, rocketed up to over $46 million this year from about $12.7 million last year. This is a very significant increase, clearly showing a big investment push. In financing activities, they had a positive cash flow of almost $11.3 million this year, a big change from a negative cash flow of about $3.7 million last year. This was mainly due to new borrowings, which makes sense given their heavy investment in assets. They recently boosted their credit facility from $40 million to $60 million and extended the maturity date. This gives them more financial flexibility, which they clearly need for their expansion plans. Speaking of expansion, they're opening new campuses in Houston by the end of 2025 and Hicksville by the end of 2026. This aggressive expansion strategy is a major focus for them. Looking at their segments, the campus operations, which is their main business, saw revenue jump 15.1%. And operating income for this segment nearly doubled, going from about $10.1 million to over $19.3 million. This core business is definitely performing well and becoming more profitable. However, their corporate expenses, which are those unallocated costs, also increased significantly from about $10.7 million to $16.4 million. This is likely due to the support needed for their growth initiatives. Now, a brief look at management's assessment here. It seems their CEO and CFO have affirmed that their internal controls are working well and likely to keep it that way. But for risks, they're not seeing any major new ones beyond what they've already disclosed. This suggests they believe their current strategies are managing the known risks. They also mention their share repurchase program, which they've extended again. They haven't bought back much stock recently, but have a significant amount of money, almost $30 million, still authorized for future repurchases. Now, let's put on our analyst hats and look at the bigger picture. Lincoln is in a growth phase, and it's clear from their financials. The revenue growth in their core operations is strong, and their profitability is improving. This is a positive sign showing that their business model is working and scaling effectively. The big challenge, however, is the heavy investment required for their expansion. They're spending a lot on new campuses and programs, which has led to higher operating expenses and a lower cash balance. This aggressive expansion strategy is a double-edged sword. If successful, it could lead to significant future growth. But if these new campuses don't perform as expected, or if there are unforeseen regulatory changes, especially concerning student financial aid, it could strain their finances. The education sector is also heavily regulated, and any changes in government funding or rules could seriously impact enrollments and revenue. This is a constant risk they navigate. Overall, Lincoln seems to be making smart moves to grow and improve its core business. The improved profitability is a testament to that. The expansion is ambitious and carries risk, but with the credit facility increase, they appear to be positioning themselves to manage the investment. The key will be executing this expansion effectively and ensuring the new campuses and programs quickly become profitable to offset the high upfront costs. Alright, that's our deep dive into Lincoln Educational Services' latest report. What do you think about their growth strategy and the risks involved? Let me know in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more corporate intelligence. And don't forget to join our Discord community for even more exclusive content and discussions. Thanks for watching, and I'll see you in the next one.